Welcome everyone to this week's KingsCrowd Investment Roundtable. This is where we're going to break down all the different industry trends, different insights, look at some charts that we've been putting together that analyzes data, and talk about some of the most current and available investment opportunities. Today, we have a great agenda for you. We're going to be talking about some of the top revenue growing startups from 2022 to 2023 that are currently live. We'll also then be diving into a currently available opportunity, Lexi. First off, I'm joined by our two senior investment associates here from KingsCrowd. Léa, welcome back from your vacation, your trip abroad. How are you doing today?
Thank you, doing good. It's nice to see you again, Brian and Teddy. You didn't change in 2 weeks, so that's perfect.
All right, excellent. And on the other screen, I'm joined by Teddy Lyons. Teddy, how are you?
Doing great. Good to be here.
Awesome. Well, let's jump right into things. For the first part of our discussion today, we are going to be talking about the chart of the week that Teddy here actually put together, which was looking at the top revenue growing startups in crowdfunding from 2022 to 2023. I'm going to pull that up on the screen, but as I do that, Teddy, do you want to kick things off?
Yeah, absolutely. So one of the main criteria that investors look at, whether it's crowdfunding investors or VC or kind of investing abroad, is, how has the company been growing over the years? In particular, with startups that are generally not profitable, we tend to look at, strictly raw revenue growth. So what we did here is we looked at all of the active raises currently available in the equity crowdfunding space and looked at which ones saw the most revenue growth from 2022 to 2023. So here we see Pacha, Original Brands, Ourbond, Boarding.com, and AtomBeam. So these are 5 companies. A few of them, we've seen before in the equity crowdfunding space, but these companies, they're currently live. I think Boarding.com is actually closing pretty soon, but they saw the most revenue growth between Reg CF and Reg A companies in the equity crowdfunding space from 2022 to 2023. So as you can see, very, very high revenue growth, everything above essentially 380%. And I think it's important to take these all with a grain of salt because they are 2022 to 2023. We're currently in September 2023. So a lot of these revenue metrics, it's important to look at, has the company provided more information on how they're doing in 2024 to see if they're kind of keeping up with this revenue growth. It's kind of one of the many metrics you should use when evaluating startups and kind of seeing the historical trends, but also trying to figure out how they're doing in the current year. So that's sort of it was the idea behind this chart as sort of, one of the metrics you can use when evaluating companies like these. But yeah, Léa and Brian, curious on your take when looking at revenue growth in the startup space.
You see, the first thing that really jumped at me when I saw this chart is that the 2 first companies are food companies. I was kind of expecting to see more technology companies be on the top of that chart, but it looks like some CPG brands are actually performing extremely well online. And the other thing that kind of jumped at me is that I was expecting lower dollar amounts because when we talk about revenue growth, the revenue growth is always the revenue growth percentage is always way higher when the dollar amounts in terms of revenue are lower. It's just easier to have 100% growth when you go from $50,000 to $100,000 than when you go from 1 million to 2 million. But yet, Ourbond is really the most impressive one right now. They jumped by close to $6 million in revenue between 2022 and 2023. And as a disclaimer, Ourbond is one of our investments, but that growth is definitely something that made us invest. I know that the growth for 2024 it's going to be as steep for a couple of reasons, but they are still managing to grow the revenue this year.
It's a great point, and I think, again, you have to look at, like you said, what industry these companies are in. With CPG companies, it's generally a bit quicker to get a CPG product to market. You just have to, mobilize your customer base and certain food or beverage, which tends to have a much quicker sales cycle than say a new technology company that's releasing a new software, going against some legacy players. That's a much different sales pitch than a CPG product that you're selling online. Maybe you have some distribution to some retail stores. So again, you always have to look at these metrics in the context of many other factors, including what industry they're operating in and what type of product it is.
Another thing I took away from this too, other than being impressed, frankly, right, from some of these growth numbers, and like Léa said, with Bond going from 1.4 to 7 million, that's huge. It's not a small number in the denominator by any means. Now, one of the things investors definitely need to look at with all of this, right, are the valuations that these deals are being offered at. So I think growth and revenues are one part of that picture. But again, some of these companies, I actually did take a look at a few of them, and you might actually be able to find a few of these for 5x, 10x revenue multiple, which, for earlier stage companies, especially ones that are growing 400 or 500% revenue growth at already millions of dollars, can be a relatively good deal. So I was a little bit surprised, where there's actually some reasonably valued high growth deals that are out there today. And I think that's one of the really important reasons why we wanted to highlight this for investors, where they can go and here's a few ideas of interesting deals to take a look at. But then for every investor, it comes down to their own investment preferences and does it align with your investment goals. Anything else on this chart, Teddy, before we head over to talk about Lexi?
Yeah, I'll add one piece of it, which is when you're evaluating, particularly med techs and early stage pharmas, a lot of times those companies will put grants, especially government grants, in as a revenue line item. So it'll say they have like $2 million of revenue, but they obviously still pre-revenue, pre-product in terms they're not actually selling the drug or med device yet. So I didn't include those in this analysis because it's not actual sales of products. So something to keep in mind as you're evaluating companies, especially in those pharma med tech type of companies, to take a look at if they have revenue, seeing if it's actually from selling the product or if they're using some accounting not tricks, but some accounting ways to put that as revenue. So
really good point. Excellent. Let's transition over and talk about a currently active opportunity, one that the investment team has been taking a look at and talking about, and that is Lexi. Lexi is a company currently raising on Republic that has actually done some prior fundraising rounds. So I'm going to pull up their deal page here and then turn things over to Léa to talk about Lexi.
Lexi is probably one of the most interesting deals currently available because Lexi pivoted between its latest crowdfunding raise in that closed early 2023 and now. So at the time, Lexi was actually a company developing sensors that could interconnect IoT products from various brands. So, meaning, let's take a very basic example. You have an Amazon Alexa speaker and an Apple TV, as well as lights that are, managed by Google Lights, where Lexi is kind of allowing you to connect all of these products together and be able to have them be interconnected, even if they're operating on different systems. What Lexi was really doing was not selling B2C, was selling B2B. So they were a white label company that were selling a solution for brands that wanted to build connected products, allowing their products to be connected to any other system. And Brian, I know you're familiar with the company. Can you tell us what was interesting at the time when we actually labeled Lexi a top deal at the end of 2022? What was exciting for investors?
Absolutely. And I will also make that disclaimer up front. I did invest in their prior round. So when you take a look at their funding history, that 2023 raise on Republic, I did invest in that. So just want to make sure we're being completely transparent. But one of the things that was really interesting to me, and I think to us back in that original round, was this concept of building this kind of platform as a service for IoT, the Internet of Things. So this is that market of think of all the smart devices in your smart homes and connected to different Wi-Fi hotspots today that really powers everything you can think of, right, in terms of the world. So that was something that was very compelling from a huge market opportunity. And just thinking, if you have thousands and thousands of these devices everywhere, having a way to kind of link them up into a system and having a platform to be able to operate that on seemed like it was solving a large pain point. And in fact, if we go back actually to take a look at one of their past funding rounds, so the one from 2023, you can see in their financials, they were solving a large pain point. So they had nearly $2.5 million of revenue for that fiscal year, probably back in 2022, which was showing that there was definitely traction. There was definitely a need that they were looking at. But obviously, within kind of the past, I think, year or so, it sounds like they have now started to pivot to this new smart building management system. So, Léa, maybe you could tell us a little bit more about their current approach.
Yes, right now they are focusing on decarbonizing buildings. They're still using the same technology, the same sensor technology that they have, but instead of using these sensors to interconnect small appliances into your house, they're using this sensor to collect data and automatically adjust light, heating, and water into buildings in order to decrease the energy bill and the energy usage for building managers. And, some of you are going to be directly seeing what is the need for this product because maybe you're aware, you're concerned about climate change. But as you know, what really makes things move in a market is not only what customer want, what is good for the planet, but does it make a financial sense? And in that case, in the case of Lexi, there are two reasons why this product actually makes sense on the market. The first is that by decreasing tenants' energy bills in in buildings, in apartment buildings, Lexi can help tenants, well, be more comfortable financially and can have the building pass along the cost of Lexi to their tenants, meaning that either the tenants will make savings, we have savings, either the building owners will have savings, and you're going to end up with a financial gain. And the second incentive to using Lexi's product for its users and for building managers is that while there are more and more legal pressure to force buildings to actually decrease their energy consumption. If you take a look at Europe, the European Union enacted recently the Energy Performance of Building Directive, which is directly translating into the European Union members' laws, where they are forcing their buildings to reduce the energy consumption. If the buildings are not compliant, they can have to pay pretty significant fines. And in the United States, a couple cities or states are also enacting similar laws, like New York, which enacted the law 97. It's expected that in 2024, New York could collect $213 million of fines from from the buildings that are not compliant. And this number could go up to $1.3 billion in 2040. So we see that there's a real pressure here on building owners to reduce the energy bills. Now, we're going to have to think about, how is the incentive going to be applied on building? And that's going to tell us whether this is actually going to be a must-have product or not. On this point, Teddy, I'd like to know, what do you think about the governments actually applying this, actually finding the buildings? Do you think that's something that's going to happen?
Having widespread government regulation on decreased carbon emissions, like on paper, can be, a good direction to move, as the climate crisis continues to rage on and everything. I do think that, we've seen this before, but it's going to be difficult to implement, especially large scale national regulation on whether it's cars, emissions of buildings, apartment buildings, and homes. It's going to be hard to really enforce regulations super strictly. So I think that's going to be one of the problems Lexi is going to be going up against. Is I think a lot of these, especially large scale commercial properties, commercial residential buildings, they're going to find ways to skirt regulations and find loopholes and things like that. So I think it's going to be a tough regulation to enforce, like widespread. I think New York, it seems like they're doing a decent job of it at the moment, but I think across the nation, it's going to be hard. But that's obviously part of the bet. When you're betting on startups, it's or not betting is not the right word. Investing in startups is seeing how the incentives are going to align long term, and if is it something that's really going to happen. And when it comes to government regulation, especially when it comes to climate, it's very dependent on a lot of things. Congress, who's in the White House, things like that. Whether carbon emission regulation is a priority for them. So a lot of things to consider.
I think we've done a great job kind of highlighting what it is that Lexi is pivoting to. I'm curious, what do you think in terms of this actual opportunity? So, taking a look at our KingsCrowd deal page, did get a pretty high overall rating of 4.8. You can actually see in terms of the ratings breakdown, there are some questions around the performance and the price categories. So, what do you think in terms of when you look at this deal? What are some of the questions or other things that you would be looking into?
Yes, we can see right here the market is huge and growing despite, what Teddy is mentioning. There's still a push to decarbonize buildings. The team is also has a great experience, and the company is pretty well differentiated. Even if there's a pretty competitive space, Lexi does have that expertise related to the sensors. It has a pretty affordable price for buildings, so Lexi has a lot of good assets. And you're asking us about what are the questions that we're asking ourselves. Well, the first question that is jumping at the eyes of investors is the revenue. When Lexi was a top deal in 2022, we were seeing revenue jumping from 52,000 in 2020 to 2.5 million in 2021 and stabilizing around 2 million in 2022. And we were very excited at the potential growth for the company. Unfortunately, in 2023, the revenue went down to a little bit more than $200,000. And in 2024, it shouldn't really go higher than $300,000. The issue here, according to the founder, is that in 2021, 2022, the company had kind of this large one-time order that made the revenue jump, which is completely understandable. But now investors are looking back at the number and they're wondering, well, where is the growth that I want to see? The revenue is going down. And Brian, as a previous investor in Lexi, what can you tell us about that?
Yeah, exactly. That would be one of the questions in my mind. So when I try and take a look at the company, we can take a look at the past performance, but given that they are doing a pivot, you got to start thinking, what is the future potential for this? And obviously one of the important parts of any deal is the price that it's being offered at. So from the deal terms, we can see the normal deal term valuation cap is $30 million. I believe there may be an early bird term available out there that may have a discount for the first few $100,000. But if we take a look at the funding history in terms of the valuation, that's the same valuation that the company was at back in 2023 when they also had 2.5 million in revenue. So from a purely revenue multiple perspective, this deal may look a little bit overvalued, a little bit pricey, right? Where they're kind of keeping the same valuation, but they now have a much lower revenue justifying that. However, there are some things you can balance with that, right? They've done a lot of learnings along the way. I believe they've filed some patents that they may have had then, but there is this IP also backing up a lot of their experience and expertise. So investors, again, need to kind of take a look at the whole package where revenue is one part of that and, potential revenue growth, but also taking a look at where they are in terms of positioning themselves to try and capitalize on the market in the future. Teddy, I'm curious, when you took a look at this deal, what stood out to you, if anything?
Yeah, I mean, the first thing, like you mentioned, was the valuation and how it's pretty much stayed, yeah, or has stayed flat over the three crowdfunding rounds. And I think generally when a company goes through a significant pivot, they generally price the valuation. They usually price that additional risk in and lower the valuation because look, they're doing things completely, not completely, but pivoting to a different go to market strategy and kind of target customer. And that increases the risk. This company went from millions in revenue to now pivoting and now into six figures of revenue. I would have liked to have seen that risk priced in a bit more. And look, there's a lot of different incentives that are coming into play. Like if a company does go through a large down round, that's generally seen as a negative thing towards investors, even if their justification is completely there. So I'm not saying this is the case with Lexi, but you see a lot of companies kind of not be very afraid to do down rounds, even when it's appropriate, just for fear of like investor backlash and things like that. So,
and one other note as well. So, taking a look at their Form C filings where they have to declare their team size, we can also see they've been going through some team reductions. So they were, 30 to 32 employees in the past few years, and now looks like about 6 full-time employees. So there's probably still contractors and other people as part of the staff, but it looks like they've also been trying to reduce their team size through this transition, potentially to try and extend their runway. But, that is one of the current things with their cash on hand and the current burn rate. Potentially a low runway is another thing to be aware of here. Anything else, Léa, from your perspective before we wrap up?
Well, I still think that Lexi does have a good product with a real need on the market. And now, as Teddy said, there is an increased risk compared to last year's top deal, which is something that was very difficult. It was just impossible for investors to see what will happen with Lexi. Now, I want to stay optimistic, mostly also because you have your money into this company, Brian. But I do think that if Lexi can change its team, hire people that have the right network, the right expertise in the decarbonization space, it could be able to sell its product and fight against competitors that have been on the market for way longer than they have. So I can be completely optimistic, saying this company is going to work. This is how you're going to make money, but it's not all lost for Lexi. There's a potential here, and I hope that we can trust the team to make the right decision. And the market and the competition will also play a lot into the future of the company.
Excellent. So if anyone does go and take a look, the one other thing they might notice that we'll just point out, if you look at their funding history, they did actually briefly launch on Start Engine this year. Now that round was closed down and they transitioned over to Republic. Just something to be aware of, where it looks like that they did actually have a raise, but then decided to change platforms, potentially for some marketing or some other reasons. But just in case investors are curious what that extra raise is there, that's what that was. All right, I think that was another excellent episode. Thank you for your time, Teddy and Léa, today, diving into this. We'll be back again next week to go into some more deals, investment opportunities, and some data and insights. For anyone who's interested in learning more, make sure you head over to KingsCrowd and check out all of the amazing tools that we offer for investors. We also have a weekly pitch reviews newsletter where you can get a deep dive on a different pitch review for a live opportunity, as well as these charts of the week where we dive into a lot of the data and insights. We'll see everyone back here next week.